First off, thanks for coming through and taking the time to watch my video. I really appreciate that. But I have to let you guys know that nothing I say is financial advice, and I'm not responsible for any wins or losses you take while trading, and I am by no means a licensed financial advisor. Now that we got that out of the way, let's go ahead and hop into this video. So, a couple kinds of liquidity. We have our structural liquidity. Any kind of structure, whether it's internal or external, whether it's the 5-minute or the 4-hour, we have liquidity at these levels. There's going to be stops at both of those levels. Now, obviously, the higher the time frame is going to provide you with a more or a higher level of liquidity. For instance, there's going to be more stops above a 4-hour high than there are above a 5-minute high. Because while all the time frames do matter, just think of them as data sets, and you're looking at a larger set of data when you're looking at a higher time frame. So there's larger amounts of liquidity behind these levels. Now, it goes the same with internal and external structure. Our swing highs and swing lows are definitely going to have more liquidity beyond them than our internal lows, but both do have resting stop orders on either side of them. Now, another really common form of liquidity is our double bottoms or our double tops. This is a very common retail pattern that people love to say, okay, this is support. They always look at that like support, or if we have double tops, same thing. They're going to look to go long right here. Now, we know a lot of times what happens is price, so maybe we made a double top, but then soon after, we see price come back down, take those stops, and then proceed up. Now, I'm not saying that they never work. Some of you might be watching and say, oh, that's not true. I've used a double top and double bottom before. I'm not saying they never, ever work. But most of the time, the way we should be looking at them as just liquidity. Now, for instance, let's say you have a POI right under a double bottom. Even if it came within 5 pips of your zone, but if it didn't hit your zone and form that double bottom, that is called inducement. I know that you've probably had a feeling where you watch this happen and you say, oh, dude, I had the wrong POI. It went for the fair value gap. You're looking through 25 different time frames, wondering why your POI didn't hit, and then you force the narrative that you want and you go long right here. Then you get stopped out. Price goes where you wanted it to. So this can happen to people even that are aware of these concepts. Inducement, especially in crypto, especially with Bitcoin, that almost happens with every single price range across every single time frame. That's why when we went over the system that I use in a lot of my trades, we require a liquidity rate. Now, it may help you refine your win rate, but it's also going to cause you to miss trades. But you should be okay with that, because you don't want to get long above an area of liquidity. Now, if you're trading pro trend with the 4-hour, that doesn't mean you can't take a trade at what you're anticipating to become the high or low. We know that we trade with structure. That's what I mean when I say our high time frame bias means everything here. So another common form of liquidity is going to be our trend line liquidity. So let's say this happens right here. So retail looks at the trend like this. So they say, oh, the downtrend or the uptrend's broken. We're going down. So there's sell side liquidity on this trend line. Buy side liquidity is above the current price, and it's buy stops, or people who have stops to close their shorts, or they're looking to trade breakouts. Just think of it as selling or buying interest among retail traders. So here we know, from a structural perspective, we know that our high and low is right here. So this is all just internal structure. No trend was broken for us. We probably just came back down to form our high or low. But retail looks at this trend line breaking as a signal to get out of their longs and sell to smart money, or they look at it as a signal to just sell and short. In reality, we know that there is a lot of orders resting among this level, that supply zone, because smart money enter the market there. They spam the orders into the market. Price comes down, induces retail traders to go long again, takes them out. Then they go short, and then price goes back up. That's just the death cycle to a lot of traders.
Thanks for making it to the end of the video. If you want access to the private Discord, use code CASPER, all caps, to start your free trial. That's where I provide my trade signals, teach my private classes, and you have access to one of the best trading communities out there. I really appreciate you guys taking the time to watch my content, and if you ever have any questions, feel free to hit me up on any of my social medias. They are all down in the description with the link to Playbit. Have a great day, and remember, if you can't see the liquidity, then you are the liquidity.